In a country where more than 1 million young people enter the job market each year, Kenya should be a land of opportunity. But for many, the dream of starting a business dies at the gates of City Hall, buried under paperwork, strangled by outdated laws, and dismissed by a society that praises entrepreneurship but punishes risk. Nairobi, often celebrated as the Silicon Savannah, a testament of innovation and burgeoning digital economies. Kenya's official standing in global business ranking suggests a streamlined environment. The nation notably improved its global rankings to 56th in the 2020 World Bank Doing Business report, a significant jump from 61st in 2018. So basically, in terms of ease of doing business, we ranked 56th out of 195 countries in the world. The nation's economy has demonstrated considerable resilience with a GDP growth of 4.5% in 2024, following a robust 5.6% in 2023. Yet beneath this polished facade of progress, a staggering different reality unfolds for countless aspiring entrepreneurs. As an aspiring Kenyan entrepreneur, you'll struggle with bureaucratic barriers to entry, institutional chaos and overregulation, youth and cultural disillusionment, and then difficult and unclear regulatory policies. Remember that Kenya's GDP of $121 billion as of 2024 means that Kenya is still a lower middle income economy. Registering a business in Kenya has become easier on paper, but that only solves part of the problem. Entrepreneurs must still navigate multiple layers of permit. A Nairobi shop, for example, needs not only national registration, but also county trade licenses, sector-specific permits, and tax registration. Each county has its own forms, fees, and timelines. So a retailer open in one county must often apply again and pay again in another. A legal review found that the precise types of documents, amounts of fees, and the legally mandated timelines for processing applications can differ considerably from one county to another. Some counties have digitalized these processes, but many still rely on slow, paper-based bureaucracies. The upshot is that what ought to be a quick license can drag on for weeks or months, derailing business plans. Additionally, the limited access to capital, or otherwise the credit crunch for startups, remains a significant hurdle. Even after dealing with the paperwork, many entrepreneurs hit a brick wall when looking for capital. Kenya's banks are notoriously conservative. One World Bank study found that 88% of small borrowers are required to post a collateral worth 240% of the loan amount. In other words, to borrow 100,000, a small business owner often must put up assets worth 240,000, an impossible condition for most startups. With the limited formal credit, young businesses must rely on personal savings or expensive mobile loans. Venture capital and angel investment are still rare outside Nairobi's tech scene. So most Kenyans starting in trade, agriculture, or services enter the game heavily underfunded. These financial barriers compound the paperwork hurdles even after spending time on applications. Many startups simply lack the guarantee to be approved for a loan. Kenya's regulatory landscape is famously fragmented. Take fintech, an often cited example, digital lenders and mobile money startups routinely face excruciating license delays. One recent report notes that obtaining payment service provider license necessary for many mobile payment firms take up to 2 years due to bureaucratic approvals. Meanwhile, in late 2022, the Central Bank of Kenya approved only 10 out of 288 digital applications. The other 278 companies left in limbo were banned from Google Play Store for lacking a license. This resulting in numerous Kenyan fintechs having been forced to partner with established banks or telecoms just to operate, or shelve their plans entirely. For many Kenyan startup founders, the regulatory maze feels endless. Licenses for mobile payments or lending platforms must pass through multiple agencies, a process that takes years. More generally, licensing is handled differently from county to county. Though some counties offer online portals for trade licenses, others still require in-person visits and stacks of paperwork. Laws have envisaged a single business permit to allow operations across all counties, but implementation is uneven. Entrepreneurs cite stories of submitting a perfectly good license in Nairobi, only to be told at a Western Kenya county border that another permit is needed, sometimes at an expected high fee. These inconsistencies mean that even seasoned business owners can't be sure what the rules are until they try to expand or move locations. Kenya's overregulation doesn't just stop at the entry, it follows you as you try to grow. Take the example of small food vendors. They're often hit by both national laws, Public Health Act, Trade Licensing Act, and dozens of county bylaws, many of which are outdated, conflicting, or poorly communicated. Regulations are enforced arbitrarily, mostly through intimidation and bribes. One small mistake, one missing receipt, and your goods are impounded. In Nairobi, city askaris Kanjo regularly raid hawkers and micro-entrepreneurs using force and confiscation to enforce compliance, but there's no clear guidance on what compliance looks like. I want you to see the international contrast with countries like Rwanda. Rwanda now ranks amongst the easiest places in Africa to start a company. There, a government one-stop shop allows company registration, tax ID, and a one-year visa within days, a turnaround Kenya aims to emulate. In the US, support agencies like Small Business Administration backs new entrepreneurs with guaranteed loans and training programs, smoothing the startup path. By contrast, Kenya's promise of streamlined services is still a work in progress. In Kenya, government initiatives such as Uwezo Fund, the Kenya Youth Employment and Opportunity Project, have shown minimal positive results. Providing training, coaching, and small grants, although well-intended, they lack the follow-through. Young people are trained, sometimes given token capital, but no long-term mentorship, no networks, no supply chain links, no policy support. Many quietly give up. Kenya celebrates hustling, but at the policy level, entrepreneurship is still seen as a backfall, not a career path. Parents push children towards formal employment, often dismissing business ideas as unserious or plan B. Additionally, entrepreneurship is often misunderstood as an act of desperation. The average youth who opens a mitumba stall, car wash, or online thrift shop isn't cheered on. Society mocks their hustle until they succeed. In schools, the system rewards obedience, not innovation. Entrepreneurship education is either theoretical or treated as a sideshow, not a core skill. Parents often encourage university and corporate careers over trade or startups. This mindset can stigmatize failure even among the highly educated youth. Formal sector jobs are scarce, as one Nairobi inequality researcher observed. Recent anti-tax protests were led by educated people. Most of them were jobless. The specter of struggling small traders, long hours, late payments with no social safety nets looms large. At the same time, ambition remains high among Kenyan youth today. Surveys show that 60% of Kenyan young people say they'd prefer to start their own businesses rather than seek public sector job. This gap between ambition and opportunity creates tension. Some young entrepreneurs turn away from businesses when they see others fail under the burden of compliance or when family pressure mounts. Others adapt, quietly starting ventures on the side or with help from savings groups, but often without scaling up. In short, the culture of entrepreneurship in Kenya is still maturing. It coexists with a strong fear of failure and a difference to traditional career paths. So conclusively, one could argue that Kenya's culture is trapped between admiring success and mocking the grind it takes to get there. This toxic mix kills resilience and fuels disillusionment among the youth. Finally, Kenya's youth bulge of over 80% of the population under 35, which was once seen as a demographic dividend, in reality, frustrations are growing. More than 40% of young Kenyans are unemployed, despite high education levels. In recent years, this economic pitch has fueled cynicism. An Afrobarometer survey found that a majority of Kenyan youth view the country as headed in the wrong direction and cite unemployment and cost of living as top worries. A sense of hopelessness where 76% of Kenyan youth are considering immigrating in the next few years. The picture that emerges is one of systemic hurdles, not a lack of talent or ambition. Kenyan entrepreneurs, from market traders in Kisumu to tech founders in Nairobi, must contend with a thicket of regulations, high startup costs, and mixed cultural messages. The government has signaled awareness. Recent reforms and the proposed startup bill offers some hope. For example, new tax incentives and a dedicated fund for innovators. But lasting change will require streamlining processes across national and county offices and truly enforcing measures like a single nationwide permit. It will mean expanding finance, using Kenya's digital collateral registry to back more loans, and building support programs, mentorship, incubators, business training that match youth enthusiasm. Finally, it may take a cultural shift, celebrating entrepreneurs as job creators rather than oddballs, so that young Kenyans feel not only empowered to start businesses, but supported in making them thrive. Thanks for watching and your unwavering participation in such very informative conversations. I've created an episode 2 where I take a look at the price of doing business in Kenya, our broken systems squandering golden opportunity, as I explain why I continue to believe that Kenya stands at crossroads. We have a young, vibrant, creative population eager to build, but we've placed them in a hostile environment, where the government is a gatekeeper, the laws are traps, and the culture is dismissive, and success is rigged. If countries like China could transition from state control to SME-driven growth, and if the US could use the Small Business Administration to backstop youth and veterans into owning businesses, Kenya too can reinvent itself. But it requires political will, institutional courage, and a commitment to real change, not PR slogans like hustlers.